about 1031 exchanges. We have a special guest, Esther Auerbach, and she is going to cover the ins and outs of 1031 exchanges here on the Real Estate Show today. And if you missed this show, you can go to realestateshowOregon.com. Is that right?
That's it.
Okay.
There's quite an archive of shows and information there too, Don. And the best thing is in the course of an hour, our guests are pretty adept at putting out a lot of information. And so sometimes it's handy. Even I've catch myself going back to listen to a little part of a segment because I've kind of dialed in or have a client that has a need that might be served by knowing a little more about that. So a great resource to have those archives there at realestateshowOregon.com.
That's right. And, 1031 exchanges have been around for a number of years, haven't they, Esther?
They have. They actually go back to the 1920s. But in the old days, of course, 1031 exchanges were done very differently. People would literally swap cows, livestock, and homes and everything. And in 1981, the current regulations were issued where we have very, very strict requirements. But these days, when you do a 1031 exchange, you know upfront that it is going to that it's going to hold if you are audited.
Yeah.
At least that we pride ourselves in handling exchanges.
So the good old days was a barter situation,
right, yeah.
Basically. Hey, let me trade you my livestock.
I got some good goats.
Yeah. Hey, that's pretty cool.
Yeah.
That's too bad the IRS gave up on that.
We should have Esther give us a little background on your history and work in the industry and how you help people with 1031s and how you got to come by all this great information and knowledge.
Sure. So I started out in the industry as a loan agent doing loans, and I quickly moved over to a title company, and I became an escrow officer, and I loved escrow. It was great, but once I learned about 1031 exchanges, that just kind of really intrigued me. I'm a numbers person.
Yeah.
And so
I was going to guess that. You love title.
I did, yeah. Yes. But I think when I went over to the 1031 exchange side, I found my passion. I've been handling 1031 exchanges since 2002 with Old Republic Exchange. And I can honestly say that I'm never bored. It's such an interesting and broad topic that there is always more to learn and always something new about every transaction.
Very good. So you do have a vast background. You understand the real estate world for sure. And then this specific topic is designed to help people defer taxes. Can give us just a little basic overview to catch people's attention on what they could possibly do if they owned investment property.
So the 1031 exchange code is for investment properties, as you said, Don. It's not for principal residences. But any time that a person sells an investment property, they have a choice. They can either fork over, in general, about 25% of their gain to the IRS, or they can do a 1031 exchange and defer the gain. And by deferring the gain, they get to keep all of their gain so that they can reinvest it and put it to work for them.
So capital gains are about 25%.
Yes, the federal rate is 15%, and the state rate in Oregon is 9.9%. And that's a general rate, of course. So when you round it up, it's approximately 25%. Obviously, everybody's specific tax rate is different, but in general, that is the capital gains tax rate.
But people can defer that.
Absolutely, yes. And one thing that people sometimes don't realize is that, yes, the 1031 exchange is for investors, but there are a lot of people who don't think of themselves as investors. They buy their starter home and then they move on to a second home and they keep the original as an investment, and that makes them an investor. So that's something to think about when they are thinking about selling that second property, that investment property.
That's important, I think, for people to know. It's not going to help you if you're just moving up. You've had your home for 10 years and it's time now to move up and to move on. You're still going to have to face a capital gain because it's not an investment property when you're rolling over into the proceeds to.
That's correct. So if somebody buys their starter home and then they decide that they're going to sell it to buy a bigger home, then obviously in that case they're not exchanging. And there is an exclusion for the gain on a principal residence.
Right.
And some people may be aware of that. It's $250,000 for an individual owner and $500,000 for a couple. So if you're selling your principal residence, you get to not defer, but the gain is waived up to that amount or those two amounts, and you don't have to pay anything. But if you choose to keep your starter home and rent it out, and then later on you go out to sell it, that's when you're going to need to defer the gain and do a 1031 exchange.
Right. And then they can put that into a variety of different types of real estate, right? It's people get confused about 1031 exchanges sometimes because I think the IRS rules are written like kind. And so they think, oh, it's a small 2-bedroom, 1-bath house. I have to put the money back into a residential property. But you can put it into different properties, right?
That's correct, Don. The definition of like kind, as the IRS defines it, is basically real property for real property. So it doesn't have to be residential. If you sell a residential unit, that doesn't mean that you have to buy another residential unit. You can exchange it for vacant land, for industrial property, for commercial property. You can exchange a single unit for a multi-unit building, or vice versa. You can sell several properties and exchange into only one. So there's a lot of flexibility in that regard, and it's all considered like kind.
See, and that opens up a lot of possibilities for people because, forever I heard, long years ago before I got into real estate, oh yeah, you have to put it right back into a specific type of property. No, you don't. Did you know that, Joe?
No, I didn't at all. And to me, as soon as I heard that, my wheels started turning as, what if I were someone who was wanting to start a business? And I have a couple of investment properties. Well, I could turn those around, the proceeds of those, and roll them into my 1031 for my industrial site. Maybe I don't want to lease. Maybe I want to make a long-term deal, own the property, and cut my overhead of operating my business that way. But interesting how that could be parlayed and the opportunities. And I had no idea it was beyond just a residential exchange, as you mentioned.
That's right. Now, let me ask you, Esther, if somebody wants to go into a 1031, they sell property in California, let's say, for example, and they want to invest here in Southern Oregon and turn it into a 1031 exchange, can they live in the property?
No. Unfortunately, this is 1031 exchanges are only for investment property. So both the property being sold and the one that they're exchanging into have to be investment property that's held long term.
So what if they rent the property but they still lived in part of it? Is that a loophole that's legal?
Yes, it is. It's legal. If they have a mixed-use property where a portion of it is a principal residence and a portion is investment, they can certainly do that. And in fact, when they sell a property like that, they can take advantage of both the principal residence exemption of, like we said earlier, $250,000 for an individual or $500,000 for a couple. And if their gain exceeds whatever the exemption is, they can choose, as long as the use of the property has been mixed, they can choose to exchange and defer the gain on the portion that is considered investment.
Okay, wow. Well, let's get started. Let's start with something, Esther. Okay, so here you are, Old Republic, right?
Yes, Old Republic Exchange.
You are licensed, qualified mediary. Is that what it's called?
We are a qualified intermediary. Yeah. Yes.
And then you're able to represent people between the sale of their property and the IRS to help them defer their taxes.
That's correct.
Can people do this on their own without you?
They can do it. They cannot do it without a qualified intermediary. And the IRS does not define who can be a qualified intermediary, but they do define who cannot. And so basically anyone who is representing the taxpayer in any other capacity, such as a realtor, a title company, their attorney, or anyone who is related to them, like their brother or sister, their spouse, cannot be a qualified intermediary or their qualified intermediary. So therefore, they do need a third. It's sort of a third party, but not just any third party. If that makes sense. So they have to have somebody that meets what the IRS calls the safe harbor rules.
So there you go, Joe. Don't try it on your own.
No, and I'm not a numbers guy like Esther is, so I probably wouldn't go down that route anyway. But it sounds like it's to the IRS's benefit as well to have a qualified intermediary in the mix in between the consumer and the government agency, because I think that's where saves them a lot of time and trouble. I've got to think of having their ducks in a row with people as they come to them for those 1031s.
Yep. So Don McCoy and Joe Brett here on the Real Estate Show with Esther Auerbach, if you're just tuning in, and we are talking about 1031 exchanges, and be sure to call your friends on this. This is critical information. You can also hear the show on Real Estate, what's it called, Brett?
RealEstateShowOregon.com.
RealEstateShowOregon.com.
I give it a little pizzazz there, too.
Yeah, you did good at that. I can't read my own writing. Dr. McCoy here with
McCoy's in training here. So.
Yeah. All right, Esther. So here we've got this established. People need to know, this is really, really critical, that they have flexibility with a 1031 exchange. They need a qualified intermediary to represent them, and they can go ahead and sell investment property, and they can buy just one other property, two other properties, three. How many properties can they buy?
There's actually no limit as to how many they can buy to replace the one. There are specific regulations as far as how they identify what they're going to buy, but there are really no limits. Now, one of the things that's important is that they know that there are specific guidelines to identify their property. So they can't just say, okay, I sold one, I'll buy whatever I want, whenever I want, because there are timelines that need to be observed. And also, like I said, two different ways of identifying the property, and that dictates whether they're going to buy three or more than three. Another thing that's important to remember is that in addition to having a qualified intermediary, they want to make sure that the funds are not accessible to them. That's the reason why they need a qualified intermediary, because they cannot have access to the funds.
Yeah, they take out and go buy a boat in the middle of this and say, well, I'll have a little bit left over and I'll put the rest into real estate. That'll botch the deal, right?
It depends. If they do it up front, when they have first of all, they have to decide whether or not they're going to do an exchange before they close on their sale. Because once they close on the property that they're selling, if they didn't set up an exchange, it's too late.
That's important. Yeah.
Yeah, very important.
I know in a real estate deal, when we're filling out for a buyer that wants to do a 1031 into a property, you have to disclose that right in that paperwork. Trying to do it after the fact gets a little suspect. Do you run across that, Esther?
Yes, absolutely. And that's one of the many things that we do. As I think you were saying this earlier, Joe, about crossing all the T's and dotting all the I's. That's what we do, and we pride ourselves in doing it well. We have to make sure that all the documentation that is required is done ahead of time, and part of that documentation is what you just mentioned, Don, is making sure that there's a disclosure to the other party. So when the taxpayer is selling their property, they have to disclose to their buyer that they're doing a 1031 exchange.
That too, and then it doesn't affect the seller of a property if the buyer is going to be doing a 1031.
Not at all.
That's important to know too. It's not like the seller has got to come up with more money.
No, absolutely not. It does. In fact, that's part of the language that is included on the contract, that at no additional cost to the seller or buyer, whoever is the other party in that transaction. So you're absolutely correct. But it does need to be disclosed to them.
So Older Public Exchange is almost like an escrow company in the intermediary third-party position that you're in. It was what you were doing for a lot of years before you got into this.
You know, that's true. It is. And that's probably why I was attracted to it. But one thing that's slightly different is that here our responsibility is to the taxpayer. We deal with other parties. We deal with the buyer on the transaction that's being sold and the seller on the one that's being purchased. But we're really representing the taxpayer
Right,
though, only.
right.
Well, in this case, it's the
good
deferred
point. Yeah,
taxpayer.
yeah. That
The
is
deferred
correct.
taxpayer. You
Yes.
don't want them to be a taxpayer, right?
No, that's a very important distinction. Thank you.
And they can roll it over again and again and again as often as that property gets sold. Then we'll talk about timelines here real soon too. So,
Sure.
yeah, and
But you're correct. They can roll it over, over and over. They can continue to exchange indefinitely.
all right. If you've just tuned in with us, Joe Brett, Don McCoy of the Real Estate Show right here in Southern Oregon every Saturday at 11 o'clock. You can't miss us. And, Joe, have you ever asked people if they have a real estate question, if there's an email address they could send it in?
Pete or Joe at realestateshoworegon.com.
There you go. Pete or Joe at Real Estate Show.
So Pete at realestateshoworegon.com or Joe at realestateshoworegon.com. Not Pete or Joe in one address.
I see.
So one or the other. Pick one or the other.
All right. So here we
one
are.
or the other of us will respond.
And we'll be back. We're going to get into some secrets about 1031
that.
exchanges because Esther knows all the
I'll
secrets.
stick around for that.
And they're gonna pay off, folks. And we're back. And thank you, ladies and gentlemen, for tuning in here on this Saturday morning and listening to Joe Brett, Don McCoy, and our special guest, Esther Auerbach of Old Republic Exchange. And the topic is 1031 exchanges. So Pete's on a break, enjoying himself, and we won't tell him where. We'll let
we
him
can only
tell it.
speculate, Don. We can only speculate.
We'll let him tell when he gets back. But meanwhile, we're having a good time with Esther learning about 1031 exchanges. And folks, I sure hope you're finding some interesting information here that can save you a tremendous amount of upfront money when it comes to capital gains. So we've covered that, what 1031s are, a little bit of the history with Esther. And we've also covered details that you can invest in different types of property, not just exactly what's called like-kind property. From residential, you can go to commercial, vacant land, you can go to industrial, you can do all these kinds of things. Esther, that's really important. And you can also buy property and live in it as long as you rent out a percentage of it. That's a big deal. A lot of people don't know that. They think they can't live in that property, but you could defer taxes, live in it, and rent part of it out, depending on what kind of property it is. Huh?
That's right. Yes, sometimes people will sell one investment property that was only investment, and they decide to do what we call a partial exchange. So what they do, they buy a duplex or maybe a house that has a granny unit, and they decide to live in a portion, and of course, they would have to pay capital gains taxes on the portion that is used to buy their principal residence, but they can defer the gain on the other portion, the investment portion. And that's one way of minimizing the gain and also using some of the funds for their personal use. So that is correct.
I could build a little tiny home in the back little corner of the lot. And that would be my living space. And
Is it zoned for that, Joe?
I know. I know. You have to find the right spot for that.
Oh,
but
I see.
Additional dwelling units come to mind as a viable option, though, for folks, because even the city of Medford, and talking with the mayor and our council officers last night on our Medford Forum TV program, they're really trying to encourage ADUs, additional dwelling units, and infill and opportunities for affordable housing and rental housing within existing lots and setups that we have. And we see a lot of homes that are set up for two-family setups that could accommodate those in many ways.
That's kind of important, isn't it, Esther?
Yes,
that
absolutely.
connection Joe just made is a whole nother factor that could be brought in.
That's correct. Yes, if you have somebody that has the ability to separate the dwellings, you can't very well do an exchange and use it as a principal residence
right.
if it's only one dwelling. But anytime that you can add a second one, sometimes also if you have a house, a home that has acreage, you could conceivably do an exchange with the value of the acreage as long as that's separate from the home. And one thing that's also important to remember is that when you have a property that has been only used as a principal residence, but you're contemplating selling a portion of it as an investment, you have to be consistent with the use of the property in past years. For instance, the acreage example that I just gave. If they have been using that property strictly as their principal residence, when they sell it, they need to consult with their CPA to make sure that that's going to qualify.
Well, that would have to do with zoning, though, too, wouldn't it?
That, but also what
EFU land, wilderness wreserve land, the different types of land you're talking about. It has to be how it's zoned.
Sure. Although the IRS doesn't really care about the zoning as long as you are consistent in the use that you have given the property in terms of whether it's personal or investment.
I see. Okay. Very good. Now, once somebody gets into a 1031 exchange, do they have all the time in the world to just wait and look and look and look, and then finally they keep their money
Especially
in
a tight market like we have right now, where inventory is really limited to find that next place to go to.
Yes, and unfortunately, they don't have all the time in the world. They have 45 days from the date on which they close escrow on the property that they sold to identify in writing on a form that we provide to them the property or properties that they're going to be buying to replace it. And that date is really important because there are no extensions and no exceptions. Every day counts. Weekends, holidays, every day.
So you have 45 days to identify the property, but you haven't necessarily purchased it.
That's correct. You have an additional 135 days after the first 45 have passed for a total of 180 days from the date that you close on your sale to complete the exchange.
Right. So you have 135 days to get organized, do all your due diligence, figure everything out, and close the deal. And it has to be done not at 181 days.
That is correct. No, as I said about the 45-day, there are no extensions. Also for the 180-day, and no extensions. And if your deadline falls on a weekend, you want to close the weekday before the deadline falls, because the guidelines are very strict and they say that you have to close by midnight of the 180th day.
Yeah, very important. That's why you have an intermediary that knows all those things, that can guide you through that process and get it right for you. And they are unforgivable deadlines there. There's no getting out of them once you miss that time. And I would imagine a lot of your clients, even before their home is sold, they're already looking very diligently and very hard as to what that place is going to be to identify coming up in that 45-day window.
Exactly. Now, Esther, where does the money sit during this time? Now, once they close their property and they've identified that they're going to use the money in a 1031 exchange, where does the money go? It doesn't go in their personal bank account, does it?
It does not, and that's very important because they cannot have access to the funds, and we hold them in a trust account for them. And it has to be liquid so that when they're ready to use it, it's available to them. So you're correct. It does not sit in their own personal account. If it goes into their personal account, it's over because the IRS strictly says that they cannot have actual or constructive receipt. And having the funds go into their personal bank account constitutes constructive receipt. So even if they didn't touch it, the fact that it was in their account would invalidate their exchange.
So they could just take 25% of that deposit and just turn around and give it back to the IRS if they're going to go that way.
That's right.
That's
You're
how that's going
absolutely
to come out if they
correct.
get above those guidelines, those sales limits guidelines.
Right. 25% made up of state and federal taxes.
Correct.
Right.
Yes.
Yeah. And then, so you have an account the money goes into then?
We do. We have an account that's a segregated account for where their funds are deposited, and we take direction from them. Once they are ready to close on their replacement property, we coordinate with the title company that's handling that escrow, and there's additional documentation that we have to generate and has to be signed by them. And when they're ready to close, we forward those funds to the title company.
All right. So there you have it, folks. You have 45 days if you're in a 1031 exchange to identify the property, not 46. And you have another 135 days to close the deal, or for a full 180-day transaction, not 181 days, to get the deal done. And you've successfully deferred capital gains taxes for state and federal, right?
That is correct.
Esther, what happens if I identify this property within those 45 days, and for some reason, not by any doing of my own, the property becomes unavailable, or I'm not able to consummate or close the deal that was my full intention and intent to do so?
That's a great question, Joe. And because the 45 days come up so quickly, we highly recommend to our exchangers that they start looking for the property as soon as possible, and that not only they look for it and identify it, but that they enter into a contract and that they do their inspections as early as possible again. Because what happens is that the IRS doesn't really care why that transaction was not completed, as whether it's because the property wasn't available or because they chose not to purchase it after all, does not matter. They can find a new property and revise their identification notice as many times as they need to, up to the 45
days, in that 45-day window.
That's correct.
So you really have to be ahead of the game, and inspections really raised the red flag in my mind of, we could be 10 days down the road, almost 10 business days down the road, and you get an unfavorable inspection. You've really got to have a plan in mind to rebound.
All right. We'll be back with Esther Auerbach from Old Republic talking about 1031 exchanges after these messages. You're listening to Don McCoy and Joe Brett, filling in for Pete Belcastro, the most awesome radio host in the planet, next to us. And we will be back with more Secret. And we're back. Don McCoy and Joe Brett filling in for Pete Belcastro, who's on a break enjoying himself. And you've just tuned in, folks. Our topic today is 1031 exchanges with a special guest, an expert, Esther Auerbach of Old Republic. And my gosh, we have covered some ground, haven't we, Joe?
Well, we could probably keep marching on for a while here this morning, but
absolutely,
time constraints are what they are. May have to bring her back for some more prepping on all the topics, because there's a lot of information that goes into this that it sounds like a pretty simple deal. It's not.
And what if people want to hear the whole show?
RealEstateShowOregon.com is where all of our programs from the past few years are archived. Over 400 shows of really good information just awaiting you there.
That's right. We just finished a segment talking about time frames, 45 days to identify property, 180 to close it. We've also talked about what types of property you can invest in and move your 1031 exchange to defer your taxes. And now, Esther, let's just talk about this one thing. What if I had a huge amount of money, $1 million, let's say, I closed on a deal, all capital, and I needed to move it for a 1031 exchange? Do I have to find $1 million property to put it into?
That's a great question, Don. So what happens is there are 3 basic requirements to be able to defer the gain fully. 3 if you have a mortgage on the property, or 2 if you don't. So let's talk about, if you have a mortgage on the property, you have to buy a property of equal or greater value to the one that you sold. But it doesn't have to be just one, as long as the total combined value of
so
however
I could buy
many
two properties or 3 properties and break it up: a $200,000 property, a $700,000 property, and another $300,000 property maybe, and we might be able to make it happen.
You just spent
That's
1.2
correct.
million.
But that's okay. She said or greater.
Yes, equal or greater.
That's right.
That's pocket change.
Yeah, that's right. If you got $1 million, why not?
The second point is, if you have a mortgage on the property, you also have to replace your mortgage when you go out and buy your replacement property. So whatever the payoff amount that you paid off on the property that you sold, you have to have the equivalent or greater in mortgages. The only exception to that, if you don't want to have to pay any what's known in the business as mortgage boot or taxes on the mortgage, is if you want to come up with cash out of pocket to make up instead of having a mortgage. But otherwise, you should have a mortgage of the same value as what you paid off.
Interesting. I was in a 1031 years ago, where it was the buyer had a 1031 and the seller moved it into a 1031, and fortunately the same entity closed it. Title companies have exchanges, but you're a standalone that the title companies use. Is that right?
Well, I am a standalone. Yes, qualified intermediaries are a separate company. We're separate. Company. I can't think of anything different. A lot of us are affiliated with title companies. For instance, Old Republic Exchange is affiliated with Old Republic Title, which is in some areas, not here in the Rogue Valley, but they are in other areas. Some other companies have their own a qualified intermediary. Usually they're affiliated companies, they're sister companies. And most of the reputable of qualified intermediaries are affiliated with a title company. And part of the reason for that is something that we haven't discussed yet, but that is the safety of the funds, because you want your funds to be there when you need them. And if you are dealing with a qualified intermediary that does not have both the integrity but also the assets to cover a loss, you may not have your funds when you need them. That actually has happened in the past, sadly. And unfortunately, people who have lost their 1031 exchange funds still have a tax liability, to add insult to injury. So that's one of the things that is really important, is how to select a qualified intermediary. You want strength, you want integrity, and you want experience. You want the knowledge that the people need to have.
Okay, Esther, I'm going to throw you a curveball.
Okay.
Let's say I have $1 million to invest, maybe $500,000. Okay, let's keep it more palatable. And I cannot find a $500,000 property, but I can find a $300,000 property that needs work and needs to be fixed up. Can I still do a 1031 exchange? And because of the repairs that are going to be put into place to get it to $500,000, will it still qualify to defer taxes?
It depends on how it's structured. The quick answer is yes, but. So the IRS says that you have to buy like-kind property. And we talked about what's like-kind. It's real property for real property. So when you replace a $500,000 property with a $300,000 property that you plan on improving,
renovating,
it's that renovation is not part of the value yet, and so it's not like kind.
So the renovation would have to be done before the 181 days or the 180 days.
Yes, and not only that, it has to be done before the taxpayer acquires title to the property, because the IRS, once the taxpayer acquires title to the property, they acquire title to a property that was worth only $300,000.
Right.
So what can be done in that situation is set up what we call an improvement exchange. What that means is that we would set up an entity that holds title to the property until the property is improved. In that scenario, yes, the full $500,000 can be invested into the replacement property, and the whole thing is deferred.
It seems like that's extremely important, because how often could you come into a situation where you just don't find what you need, and then you settle for something less, but you could buy a property that needs a little bit of work, get it fixed, line up your contractors, get it fixed, and still defer your taxes, and your property that's finally worth more than what you bought it for. You'd end up ahead, possibly.
That's
way
correct.
Ahead.
Yes.
And you actually find something in an area that you wouldn't have expected, maybe.
Absolutely. There are so many different possibilities. It's I think I mentioned this earlier. No two exchanges are ever alike, and the possibilities really are almost unlimited. If one thing doesn't work out, one thing that you're contemplating, I invite people to talk with me so that we can explore different options.
How do people get a hold of you? Because I know we're coming down on the clock, and it'd be good for them. I'm sure you have whet some people's appetite for more information outside of the program.
Sure. I'm local. I'm right here in the Valley, and so I can always be reached on my phone, and I'll give it out, and I don't expect that people will be able to jot it down or remember it, but I'll give it out anyway. It's 541-500-7799. That's my cell phone, and I'm always available. The other way that they can get a hold of me is on my website. It's my company's website is www.orexco1031.com.
Esther, thank you.
Great program. Thank you, Esther.
My gosh, Joe, thank you.
Good work,
My
Don.
Thanks for
pleasure.
putting up with me. And here we are at the Real Estate Show Signing off till next week.
You've been listening to The Real Estate Show on KMED Radio, presented by the Rogue Valley Association of Realtors, along with John L. Scott Real Estate of Southern Oregon and Bank 34 Mortgage. For guest contact information, download our free app, or to watch a past show, visit us online at realestateshowOregon.com. This show is produced by Table Rock Productions. Join us again next weekend for Southern Oregon's one and only Real Estate Show on KMED. And thank you for making the Real Estate Show part of your weekend.